Good afternoon to everyone. Thank you very much for joining S&C in our Navigating the COVID-19 Crisis webinar series. Today, we will be discussing the impact the crisis has had on European capital markets. I'm Carsten Berra, Managing Partner of the firm's Frankfurt office and co-head of the firm's capital markets practice. And I'm joined by my partners, Vanessa Blackmore, John Horsfield Bradbury, and Evan Simpson from our London office, Olivier de Vilmorin from our Paris office, and Christian Czernetsky and Clemens Rechberger from Frankfurt. Turning to our panel, I would first like to talk about what you have been seeing in the capital markets over the past few weeks. There certainly has been more activity on the debt capital market side than equity. So let's talk about debt first. Vanessa and Olivier, what have you been seeing on the investment grade side?
Thanks, Carsten, and good afternoon or good morning to everyone. According to the Bank of England, in March, UK issuers issued about £21 billion worth of bonds and about £16 billion worth of commercial paper. And this number was actually down on February and also on the previous 6-month average. And I think it probably reflects the extreme market volatility that we saw in March as the scale of the COVID-19 crisis really became clear. Nevertheless, the numbers are still very substantial. And what we then saw at the end of March, and we've seen a continuation of this, is that at the end of March, the bond markets started to reopen for investment grade issuers. And I wouldn't be surprised if these numbers start to go up quite a lot as issuers come out of their quiet periods and take steps proactively to access liquidity and to bolster up their balance sheets. On the investment grade side, we've seen a number of blue chip issuers who have been taking steps to make sure that they've got maximum flexibility to access the public markets when market conditions allow. And I think this is where having a current EMTN program really comes into its own because you can update the disclosure through a supplement very quickly and be ready to access the markets as soon as an opportunity comes around. And when it comes to investment grade issuers, I think what we've been seeing is, notwithstanding all the market volatility, there does seem to be good investor appetite. And I think this has really been enhanced by the various central bank and government support programs that have been put in place. And for example, we're also hearing that having ECB eligibility is very important. And I think for investment grade issuers, the other advantage they have is that they have a lot of tools in their toolbox to make sure they maintain their creditworthiness. So what we have been seeing is programs where issuers have been cancelling dividends, cancelling share buyback programs, and actually, putting on hold their capex plans. So I think, they've been able to get pretty good terms. Interest rates are absolutely rock bottom. And so notwithstanding market volatility, the cost of issuance is probably not radically different from what it was before. I think one other feature I would mention as far as the UK landscape is concerned that's relevant for investment grade issuers is the UK's COVID corporate finance facility. This is a UK government facility, and it's specifically designated to help temporary liquidity concerns. And it works by the Bank of England purchasing commercial paper from eligible issuers. And in order to be eligible, you have to be investment grade or equivalent and make a material contribution to the UK economy. And what's interesting is that this isn't just limited to UK issuers, but it can also be accessed by foreign issuers who make a material contribution to the UK economy. And so that has been a very popular facility. And we're also seeing a lot of companies announcing, even if they're not accessing it, that they've taken steps to make sure that they're eligible so that they do have the flexibility to access the facility if needed.
Olivier, you want to give us your perspective from the French side?
Yes, in the French market was closed during the third week of March, and then it reopened the third week of March, and has been very active towards April. There has been a lot of investment grade bond issuance that were very significant, such as the Capgemini one to refinance the acquisition of Altran for 3.5 billion. The one done by Engie, by Airbus, by Aéroports de Paris, which were all multi-billion bond issuances. Interestingly, the month of April has always been active, but this one has been much more active than other months, and the market is still open. We can see that on Monday, Pernod Ricard tried to did an issuance, a second tap, following the first one that they did at the beginning of April for 500 million euro, in addition to the one that they had done of 1.5, and in fact it was oversubscribed up to 5.5 billion. So it was more than 10 times oversubscribed. So there is a real appetite for investment grade bond issuances, and the market is in France also very active. Interestingly also, as you say, the issuers are getting ready under their MTN program, and the IMF, since the beginning of April, has reviewed and approved 20 base prospectuses or prospectus supplements, which is much more than what they would usually do. And the third movement that we're seeing, and that the market should remain very active, is that in light of the lack of visibility for the second part of the year, and since the market is open now, a lot of issuers that were anticipating during their bond issuance only in Q3 or Q4 are accelerating the process and trying to tap the market before June, and are trying to use the April-May window to do that. And as you said, Vanessa, the liquidity is there, and therefore the terms and the financial terms of those bond issuance are still very attractive.
Thank you very much, Olivier and Vanessa. This is very consistent what you described for the UK and France with what we see in Germany, or have seen over the past few weeks in Germany, for example. Christian, you work a lot with sovereign issuers. What are you seeing there?
Well, look, thanks, Carsten. The funding needs of the EU member states and of the EU in the face of the COVID crisis are really colossal, and so we've seen a number of member states increasing their borrowing programs. Germany did so, raising its program from 220 billion to 210 billion to some 440 billion. The Netherlands just announced a 93 billion increase in their funding program. France and Belgium have done so. We've seen countries like Hungary issuing Euro bonds specifically for the purpose of raising capital for expenditures on pandemic defense. I think that will clearly continue. The question in my mind is what's going to happen at the EU level. So far, what we've seen principally is the PEP program of the ECB. That's the Pandemic Emergency Purchase Program, under which the ECB, quantitative easing, is acquiring up to 750 billion euros worth of both private sector and public sector debt securities in an effort to reduce volatility and to bring, among other things, periphery spreads back down. They had ballooned up to levels that we really hadn't seen since the sovereign debt crisis. I think that when it was first announced, that program was clearly successful. The periphery spreads came down, not to below pre-crisis levels, but they did come down significantly. They've since started to trend up. It'll be interesting to see how the market reacts to the ECB announcement today, which did not call for an increase in that program, although it did introduce other measures. We also have the Eurogroup agreement on a 540 billion euro a series of measures that will include loans to businesses from the EIB, health expenditure funding from the ESM, and further funding from the Commission Unemployment Fund. Last week, European leaders rubber stamped that agreement and also talked about the need to establish a recovery fund, although the exact terms of that fund, how it will be funded, whether it will grant or offer grants or loans has yet to be determined. Now, one thing I think is clear, and that is that the 540 billion price tag on the measures agreed to so far will not suffice by any means. A Commission paper that was leaked last week talks about the need for a 2 trillion euro recovery plan, and in that context, there have been various proposals that have been circulated. We're hearing again about the need, at least from the point of view of some of the southern countries from Italy, but also from France, for some form of neutralized debt issuance, Corona bonds or bonds backed by a joint and several guarantee of the member states. I think the likelihood of that form of Corona bond is coming into existence is relatively remote because it's continues to be, as it was during the sovereign debt crisis, vigorously resisted by both Germany and the Netherlands. The EC President von der Leyen had a proposal for a 1 trillion euro increase in the EU budget, and coupled with the issuance of bonds that would be backed by that budget. Something along those lines, it seems to me, is probably what we will end up seeing. Chancellor Merkel has indicated that she would be supportive of an increase in the EU budget, something that had been resisted previously, and the issuance of bonds at the Commission level, provided they're temporary in nature. Now, it's going to take some time for any measures like that to be put into place. The Commission at the beginning of May, on May 6th, is to issue proposals on increasing on the new EU budget, and we'll presumably learn more about the recovery fund at that point. I think. Building a recovery fund into the budget discussion, which is already very complicated, will be no easy task. But it's probably easier than amending treaties, which might otherwise be necessary in connection with some of the other proposals. So I think in the meantime, what we will see is continued issuances by the member states. I think we'll see issuances by development banks like KfW, which has been tasked by the German government with providing liquidity to German businesses, but also from multilaterals like EIB and the ESM in connection with the mandates I described before.
Thank you very much, Christian, for the comprehensive overview of the situation. Some of these numbers are really frightening. I remember well 6 months or 12 months ago when the German finance minister thought that he didn't have 5 billion for certain programs. Now we're talking about totally different numbers. Anyway, let's turn from the highly rated sovereign issuers to private issuers. John, you spend a lot of time working with issuers on SEC-registered or Rule 144A bond offerings. What issues should companies and underwriters be thinking about as they prepare to go to market on a bond offering?
Thanks, Carsten. That's right. The S&T team has been working with a lot of companies that have undertaken or are considering offerings. I think at one point, every company who we've worked with in the last 10 years was in touch about thinking about updating their programs. The current circumstances have had a significant impact on a number of aspects of the offering process. In some respects, we've actually found that companies that are used to frequently accessing the US capital markets and that are used to almost following a formulaic process for their offerings have faced more challenges. I think that's probably because they're used to an offering going very smoothly and quickly. COVID-related developments that have put pressure on their normal short timelines have been tough for them. Of course, it's critical for companies to ensure that disclosure appropriately reflects the potential impact and risks posed by the pandemic, and we'll spend some time discussing that a little bit later. But beyond disclosure, there are some other key considerations for investment-grade issuers, some legal and some more administrative. One of the most important questions that companies face before they access the US is whether their auditors are going to be able to provide standard negative assurance comforts that the banks will seek. We've seen a number of different issues raised by auditors, and it's critical that the company and its counsel and the bank's counsel speak with the auditors at a very early stage to understand whether there'll be any issues or any hurdles to overcome before the comfort letter can be delivered, as well as some obvious considerations such as confirming a going concern analysis. Auditors are also very focused on COVID-related disclosures, especially in areas such as impairments. For US registered clients, we found that auditors are particularly focused on the extent to which the company is following the SEC's guidance on COVID disclosures, which Evan's going to talk about a little bit later. The audit firms are also bolstering the substance, in some cases, of the rep letters they're seeking from management. And all of this can come as a surprise to a company, especially if it's not had any issue on its comfort letter in the last 20 deals. It's important to take nothing for granted at the moment. One other area that's a challenge for companies is that they're being pitched products which would just not have been relevant for them a few months ago. And so we'd encourage any clients that are being pitched instruments they're not used to get in touch at an early stage, because there's a good chance that counsel will have come across it in another context and maybe can provide some useful color. Finally, I wanted to discuss a couple of administrative but kind of important topics that relate to remote working. One is on documentary due diligence. Counsel in a US offering will still need to undertake customary due diligence. Before COVID, we still have many clients who required us to review those documents in person. Obviously, electronic solutions have been available for a long time, but there can be a significant lead time and internal compliance hurdles in implementing those in large organizations. So it's something worth thinking about early on. Another administrative development relates to settlement timing. Even clients who had always done deals on T+3 or T+5 basis have sometimes now been doing deals on T+2 basis, which of course is permitted and is the standard in the US. And so there's increased pressure on issuers and the lawyers in preparing documentation and making sure everything works, even if losing those days. But especially a few weeks ago when everything was changing so much, there was a strong desire not to have deals open over the weekend, especially. And then the final development relates to electronic signatures. We worked on a multi-billion-dollar deal recently for a client who'd never really used electronic signatures before, but for which the 50 to 100 documents for this deal they did in fact sign electronically, except for those which were filed with the SEC, which still require a manual signature somewhere. In the end, it was much more efficient than the usual process, and I think it will clearly be the standard going forward. But legal opinions as to due execution and validity were required in 3 or 4 jurisdictions on this deal, and it took some lead time to make sure all the parties were comfortable with that new technological approach.
Very interesting. Thanks, John. It's clear that issuers and their advisors will have to make a number of adjustments to the typical offering process. But what about another key constituency, the regulators? Evan, you are in regular contact with the SEC. Are they having to make similar adjustments or take a step back in their approach to regulation and enforcement?
Well, Carsten, regulators are key people too, and of course they've been affected by COVID-19. But in fact, the SEC was one of the earlier institutions to adopt a remote working policy, and the SEC staff have been working from home longer than most of us have. In our experience, they've actually done so pretty seamlessly. For instance, the SEC remains fully open for business, whether that's reviewing a registration statement, working through WIXI waiver letters, or providing interpretive guidance relevant to a COVID-19 world. And if anything, the SEC commissioners and staff have become even more active in issuing guidance to companies on how to navigate the legal and practical challenges of COVID-19. There have been a series of releases and public statements specific to COVID-19 disclosure, and they've also worked to implement accommodations for filing delays caused by COVID-19. But given how much is on the SEC's plate right now, and natural challenges of working remotely, issuers and their counsel would be well advised to consider approaching the SEC sooner about issues than would have been the case historically. Again, we just can't assume that everything will work the same way it always has before. I've been speaking here about the SEC, but I would note that the same holds true for other regulators in Europe. They've issued similar ad hoc releases in recent weeks. European regulators have also made very clear that they may challenge the approach taken by issuers to COVID-19 disclosure in the same way that the SEC will. So while times are very challenging, it remains very important today to stay focused on applicable disclosure requirements. The SEC and other regulators are certainly still focused on those matters, and early indications are that they are both stepping up their enforcement efforts in connection with disclosure and with market conduct.
Thank you very much, Evan. Indeed, that looks like a global topic at the moment, and all regulators seem to go into the same direction. Let's switch gears and talk about the equity capital markets. We have seen a few weeks in March with basically no activity, but accelerated book build offerings, i.e. private placements with institutional investors, have come back already end of March, beginning of April. For example, in the UK, France, Germany, and the Netherlands, especially primary deals with the issuance of new shares, often around 10% of the existing share capital, so that they can be done without a prospectus. We have also seen convertible bonds, partially also mandatory convertible bonds. Mostly, these transactions have not been rescue transactions by companies under pressure due to COVID-19, but rather capital raisings in industries that have not suffered or even benefited from the crisis, such as Dutch online pharmacy shop Apotheke or just eattakeaway.com, which raised 700 million through an accelerated book build offering of new shares and convertible bonds. We have also seen a number of secondary transactions, most notably a sale of existing shares in the Italian telecoms tower business Inwit by Telecom Italia and Vodafone. These transactions have been completed successfully, so investors are willing to engage also on the equity side. At the same time, it is fair to say that activity levels on the ECM side are still very low compared with previous years in Europe. And of course, one category has been missing almost entirely so far, in Europe at least, initial public offerings, IPOs. Christian, you have been advising on capital markets transactions for 25 years now. In light of the markets, do you still see issuers preparing for IPOs at this time?
Well, yeah, Carsten. I mean, IPO preparations haven't stopped, but the pipeline is by no means what it was. I mean, as you know, in March, volatility spiked. The CBOE volatility index, which measures market swings, peaked at 83. And there's a study by Berenberg that shows that 90% of IPOs that have been priced in Europe in the last 20 years have been priced when that index is less than 25. And so issuers that were looking to come to market in April or May have clearly pulled their deals, and we have a number of issuers in that situation. But the volatility has begun to come down. Yesterday it was at 31. Today it ticked up a little bit. I think the outlook is uncertain. But I would expect to pick up in activity in the second half of the year, probably with most of that activity coming in Q4. I think it'll be supported probably by the stimulus measures that are being put in place. But it will also, of course, correlate very strongly with developments on the COVID front. If there were a second wave of infections in the fall, for example, that clearly will have a negative impact. But if you're an issuer and you're looking to a possible Q3 or Q4 IPO, there's no reason to go pens down at this point. I mean, particularly if you, as you've indicated, are active in an area that has been less affected by the crisis, or maybe even benefited from it. In fact, there is an IPO that's in the market right now on the Oslo Stock Exchange for a company called Pepix, which is a Zoom competitor. And we have a number of issuers that we're working with who are looking to be ready at the end of Q2 in case the window is there. So I'm optimistic, cautiously so, but I think preparations will and should continue. From a process point of view, maybe just a word on this, picking up on what Evan said. I mean, regulators have certainly adapted. The BaFin here in Germany, its review process is continuing virtually unchanged, notwithstanding the fact that everyone's working from home. The due diligence meetings that we're having, drafting sessions on the prospectus are all being held remotely, and I think in some cases probably more efficiently than had been the case in the past. Even analyst presentations, some of them that take, as many know, basically the whole day have been happening virtually. And the same is true of investor meetings. And so I think preparations will continue. And as I say, I'm cautiously optimistic.
Many thanks, Christian. As you know, I share your cautiously optimistic view as we are working together on many of those German transactions also right now. So Olivier, what have you seen in the French ECM market?
Thank you, Carsten. And the French ECM market and the activity level is being slow for now, even if the market is pretty receptive for strong companies that have a credible downside case and also an attractive investment case in the event of recovery. Today, I would say that French groups which have liquidity issues remain focused on their financial indebtedness, including through the granting of state-guaranteed loans, rather than tapping the market right now. On the equity side, if you look at Air France, for example, if you look at Renault, they all were granted multi-billion state-guaranteed loans and have not yet implemented any type of equity offering, because I think that most of the issues consider that the market valuations are currently depressed, and they're not keen on diluting their shareholder on that basis, or even doing a rights issue with a significant discount to current market prices. So therefore, many issuers are waiting for their stock price to recover before considering any capital increase. But at the same time, they want to be the first one getting in the market. So some, I think, will try, in terms of equity raise, to launch something before the summer. I think the stronger and the most solid issuers will try to do that, while others will have to wait. The end of Q3, beginning of Q4, being able to do anything. But also, even those that did not see their stock price recover may have no other issue than tapping and issuing and doing a capital raise in September or October in order to get the leverage. Also, in light of the current market valuations, I think we're going to see innovative structures, and maybe we're going to start seeing offerings with equity offerings with premium over stock price in order to try to reflect at least partially the pre-crisis stock price level. On the IPO front, as you said, it has been extremely slow and nothing has happened since the beginning of the crisis. I think it will take a few months being able to see other large IPOs, the ones that we saw in 2019. However, the French state needs cash, and it could be possible that one way of getting that cash would be to implement some type of privatization program and monetizing some of their stakes through either block trades or IPOs of companies that are currently privately held. Also, interestingly, in France, the retail investors have come back into the market, and thanks to the crisis, they feel that the market is very low and there is only an upside in investing in the stock market right now. And so there's been a significant move of retail investors in CAC 40's companies. And since privatization programs are very much oriented towards retail often, this may be also an opportunity for the French state to carry out its privatization program. So nothing immediately, but as both of you, I remain cautiously optimistic, but for the next few months, the market will be driven mainly by equity raises rather than IPOs.
Fully understood, Olivier. Thank you very much. Also for the positive signs from France, even though we may have to wait a couple of months. Interestingly, retail investors have not come back here in Germany, so that seems to be a little different from the French development. Vanessa, there has been some relaxation of listing and disclosure rules designed to assist UK-listed companies to raise additional equity capital quickly and effectively, correct?
Yes, Carsten, that's right. Earlier this month, on the 8th of April, the UK's Financial Conduct Authority, that I'll refer to as the FCA, announced some measures that it says are designed to enable issuers to effectively, efficiently and quickly raise new capital in response to the COVID-19 crisis, whilst at the same time balancing needs of investors. And these new measures, basically, there are four things, and they're intended to give UK-listed companies the potential ability to issue new share capital within certain parameters without having to make a preemptive offer to existing shareholders. And we'll probably discuss a little bit later on what that means. Make a clean working capital statement in a prospectus or a shareholder circular, while including assumptions relating to the COVID-19 crisis. And John's going to touch on that a little bit later on. This measure is a temporary one and is in place until the FCA advises otherwise. Where possible, to make use of the simplified prospectus regime that was introduced by the EU prospectus regulation last summer, and also to avoid the need for a shareholder meeting to approve certain transactions, provided the approval is obtained by other means and a dispensation is granted by the FCA.
This is very interesting, Vanessa. You mentioned the magic words preemptive rights. Can you provide us with more detail on the exclusion of preemptive rights, please?
Sure, Carsten. This is actually quite a technical area, so I'll try and keep it as simple and straightforward as possible. So the starting point is that there are usually limits on the ability of a UK company to issue new equity securities for cash, unless it first offers those to existing shareholders or the shareholders pass a resolution to disapply those preemption rights. And these preemption rights are relevant to issues of ordinary shares, but also to convertibles. And for UK companies, preemption rights derive from English company law. And for non-UK companies that have a premium listing in the UK, the listing rules say that a non-UK company has to give the same preemption rights to their shareholders. And what a company usually does each year, it will take a general disapplication of preemption rights at its annual general meeting. And that enables it to issue new equity securities for cash other than to the existing shareholders. But it's normal for this disapplication to apply only to a small percentage of the company's existing issued share capital. Now, the limit on the size of the disapplication is actually a function of guidance to the market issued by the preemption group, which is made up of representatives from a number of UK institutional investors. And they basically have said to the market what they consider to be acceptable parameters. So it doesn't derive from any technical, legal or regulatory requirement. And before the COVID-19 crisis, the preemption group's guidelines meant that UK-listed companies would typically get approval to disapply preemption rights to issue cash for up to 5% of its existing share capital for general purposes, for another 5% for specific acquisitions or investments, and that there was an overall 7.5% limit on a rolling 3-year basis. And what's new is the preemption group has issued guidance saying that it will support requests by listed companies for general disapplications of preemption rights for up to 20% of share capital. And it's this new guidance from the preemption group that the FCA has endorsed. Now, this new limit isn't completely unlimited, because the preemption group have actually placed some additional limitations on companies. And the two main ones are that a company is expected to undertake a proper consultation with its major shareholders in relation to the new issue. And as far as possible, the new issue should be made on a soft preemptive basis. And what this means is that the bank should allocate shares to investors in accordance with an allocation policy that replicates as nearly as possible the existing share register. But obviously, there are limitations to this. And I think there's just two practical points that are worth touching on here as well in relation to this development on preemption rights. And they are that a listed company will typically need to hold a shareholder meeting to actually seek approval for this larger disapplication of preemption rights. And so for companies that haven't already issued their annual general meeting notices, there's time to get that on the agenda, and they're in the best position to take advantage of this. For companies that have already called their annual general meeting, they will either have to postpone their annual general meeting or call a separate meeting to pass the resolution, which both of these have sort of cost implications. Or the alternative, which we have seen in the market, is that companies will make a placing and an element of it will be conditional on getting a new approval in place. The other point I think it's worth just mentioning is that for a UK company, it's already possible to structure an issue of shares or a convertible by using what's called a cash box transaction, which can avoid the need to seek a disapplication and can also be used to obtain certain balance sheet treatments. These structures are not new. They've been around for many years. And they rely on the fact that the shares in these structures are not actually, or the convertibles are not issued for cash, but they're issued for a non-cash consideration, basically in exchange for other shares. But historically, the preemption group has discouraged these structures to do big, large issuances because they've said that they are subject to their guidelines. So I think the increase to this 20% disapplication is going to, in practice, give UK companies quite a bit more flexibility. And we've already seen a steady stream of UK issuers undertaking share placings in recent weeks, and we expect more to follow.
Thank you very much, Vanessa. It's always interesting to be reminded how much corporate laws differ in Europe while we try to harmonize the European capital markets at the same time. John, I would be curious to hear a bit more about the accommodations with respect to the working capital statements. Any insight you can share with us on this point?
Sure. So I'm sure many of you know the prospectus regulation requires any prospectus for the issue of new equity securities to include a working capital statement as to whether or not the issuer has sufficient working capital for the next 12 months. Under the relevant ESMA recommendations, that statement can either be unqualified, which is to say it's made without any caveats, qualifications, or assumptions, or qualified, which is rare to see, as it requires an explanation and a description of the action plan to remedy the shortfall in working capital. One of the key principles in those ESMA recommendations is that an issuer is expected to have undertaken an assessment as to whether there's sufficient marginal headroom to cover a reasonable worst-case scenario over the 12-month period. And as I mentioned before, it's not permissible to disclose the key assumptions underpinning the analysis. Now, of course, due to the pandemic and its effects, many issuers are currently unable to model such a worst-case scenario. So compliance with the recommendations would result in a significant number of working capital statements to be qualified. So as an accommodation to this, the FCA published a technical supplement. In short, until further notice, an otherwise clean working capital statement will be permitted to disclose key modelling assumptions underpinning a reasonable worst-case scenario, as long as those assumptions are only related to COVID and are clear, concise and comprehensible. Assumptions unrelated to COVID will not be permitted to be included. So that summarises some of the accommodations the FCA has made in light of COVID in the UK. Carsten, what's the situation on the continent?
We have not yet seen any such accommodations, but it will be interesting to see whether some of these accommodations will also become available outside the UK. In general, I'm really looking forward to seeing what happens to the IPO market after things start to open up again. Certainly, some companies won't have seen their businesses significantly affected, but they will no doubt be impacted by broader market conditions and investor sentiment. And then others will have seen significant adverse effects that may take time to work through. So in prior market downturns, including, for example, the financial crisis, we saw an increase in private investments in public equity or PIPE transactions, as well as other private placements. Clemens, what are you seeing with respect to private placements in Europe? Are particular industries accessing this market more than others? And do you see private equity playing a big role?
Yeah, thank you, Carsten. There are indeed lots of discussions throughout Europe, as far as I can tell at the moment, regarding private placements for several reasons. With respect to issuers operating in industries that are not or not so much affected by the crisis, we've seen undocumented accelerated book build offerings, as mentioned earlier on this webinar. For capital raisings in more difficult industries, institutional investors expect to see a significant risk premium and therefore discounts to the already depressed share prices. These discounts often mean that offerings are less attractive to issuers, discouraging them from going out into the market. Some investors, such as certain strategic buyers, large family offices, or private equity funds, may have special insights into certain industries and may therefore be willing to move forward at what the issuers may see as acceptable prices. Further, companies may be concerned about their low share prices and seek protection against unsolicited takeover bids by issuing equity capital in private placements to investors that they consider as stable, long-term oriented, and somewhat immune against short-term takeover offers. We've also seen some investors opportunistically increasing their already existing stakes in listed companies, such as Italian Mediaset in the German media group ProSiebenSat.1. As to your specific question regarding private equity, I would expect private equity to come more into this now. The last few weeks, my impression was that private equity was more focused on existing, already signed transactions and on issues with existing portfolio companies, but that might change now. Now, private placements obviously only offer opportunities for companies that are still attractive enough for institutional investors. In some industries that are hit most by the economic turmoil, private placements may not be feasible at attractive prices, requiring issuers to resort to more broad-based offerings, such as rights offerings. This is indeed a lesson that we learned from the dot-com bubble in the early 2000s and the financial crisis in 2008, 2009. And we will see rights offerings throughout Europe again. While the underlying concepts will be such as a dilutive rights offering with a significant discount to the theoretical ex-rights price based on a prospectus to be approved by the national regulator, they will be the same. The execution of those transactions will often depend on the somewhat diverse corporate law concepts in the different countries in Europe. And we heard Vanessa talk about exclusion of preemptive rights in the UK, for example. So we will see different timelines and different details, but I expect that we may see a more busy second half.
I agree, Clemens. If lockdown continues, we may see a very busy second half of the year and start into 2021. So, Olivier, for those issuers that are able to raise capital via pipes, what types of terms do you expect to be the focus of significant pipe transactions?
Thank you, Carsten. Yes, I think that will be mainly the governance rights and the protective features that are going to be the key terms negotiated by the investors, of course, beyond the pricing terms. On the governance rights, they will often depend on the amount, of course, at stake and the duration of the relationship between the investor and the issuer. Of course, the larger the investment will be, the more protective the governance right will be for the investor. That could include things like board rights and the right to appoint a specified number of board members or committee members, which is often proportional to the as converted equity interest. Of course, voting and consent rights, such as veto rights on certain key decisions to protect the investment of the pipe investor, registration rights to facilitate the liquidity and other rights which will be less relevant. On the issuer side, the issuer will be looking for a standstill provision, will be looking also for lockup provision to ensure a certain level of stability. And typically, you would have protective features in those instruments such as dilution protection and conversion, which can be either optional or mandatory depending on the circumstances. So I think those will be the key features that will be negotiated in a pipe transaction, in a large pipe transaction in the current environment.
Perfect. Thank you very much, Olivier. One, of course, big topic for every successful capital markets transaction is being prepared for open windows. At S&C, we are working with a number of issuers who need to raise capital now. However, others may have a longer time horizon, as we discussed, and simply want to be prepared for when a window opens. John, what should issuers be doing now to ensure that they are ready? And are there any lessons that can be learned from companies that have gone through the capital raising process in the past few weeks or months?
Thanks, Carsten. We've already talked about some of the issues surrounding comfort and the administrative aspects of undertaking an offering while working remotely. Evan and some of the other team are going to talk about disclosure topics in a moment. That is, of course, critical for any offering into the US, especially given the liability profile of an offering there. I think it is critical for a European company that's considering access to the US markets, whether on a registered or 144 basis, to consider the disclosures that their US competitors or comparable companies are making. You know, if you take the hypothetical where a US company discloses risks and contingencies that are applicable to its business, especially if that's in areas that the SEC has indicated are critical for investors. If a European company doesn't have such robust disclosure and undertakes an offering in the US, and then one of those contingencies comes into effect in a COVID world, then that would provide an easy roadmap for a plaintiff lawyer to bring a claim in under the US securities laws. So I think there's value in keeping track of companies' disclosure in the US, especially as the US companies start to publish their 10Qs in which they're required to update their risk factors. Changing tax, another point that needs to be borne in mind are the relevant corporate entities that will need to provide approval for any financing. Of course, this is always the case. I think companies have been good about providing frequent updates to their boards about the impact of COVID-19, but maintaining that discipline, and in particular including updates on potential financing needs in the state of the market, will be important, especially if, as I mentioned before, an issuer may be considering new kinds of instruments that are novel. Obviously, it goes without saying, as markets move quickly and unpredictable, there can be a significant benefit in being ready to access them on short notice.
Sure, totally agree, John. Christian, one other key question that we often get in times like today is how could issuers adjust their transaction structure, especially for IPOs, to address the current situation?
Well, look, I think the big challenge on any IPO transaction coming out of the crisis is going to be valuation. Investors are going to be historically have after crisis are going to be looking for higher IPO discounts than they might otherwise. Issuers will be coming off of doing the offering on the back of Q1 or Q2 numbers, which will be in many cases negatively affected by the crisis and the related lockdowns, and so obviously that's going to put a lot of pressure on the valuation analysis. And so in that context, what people are really going to be looking for is flexibility. Interestingly, as a U.S. lawyer, I'm often struck by the difference between the U.S. and the European market in this regard. In the U.S., you can price above or below the range. You can upsize a deal or downsize a deal within relatively generous parameters without needing to go to the SEC or obtaining any form of approval. In Europe, of course, that's not the case, or often not the case, as changes of the type that I just described would typically require an amendment to the prospectus, which has to be approved by the competent authority. And at least on the downside, going late in the game to reduce the price range is often a death knell for the transaction. And so people are going to be looking for ways to make changes, including last-minute changes, or to increase flexibility. In Germany, one of the things that we see is transactions which are done using what's referred to as an upsize option. So the transaction is perhaps scaled back in terms of its overall size going out, but with a view to potentially increasing the transaction in a pre-approved form in the event that the market demand is there. And the green shoe would then come on top of that. 10 or 15 years ago, when in Germany there was frequently, because of gray market trading, pressure put on price ranges such that deals were pricing below the range, or sometimes because of the approval process necessary in that case being pulled. People came up with a technique called the decoupled approach, where you go out without a price range and add the price range in an amendment to the prospectus, which is sort of pre-planned 3 or 4 days before pricing, in the hope that way you'll be able to build a momentum in the market without having a price range out there that people can attack, and hopefully resulting in ultimately in a higher valuation. I think overall deal sizes are probably going to come down. I think certainly the PE exit sponsors may well be looking at the prospect of post lockup secondary transactions at a higher valuation, but off the basis of the listing that they would have achieved at the lower valuation earlier in the game. That I think is on the IPO front what I would say.
Thank you very much, Christian. We want to briefly cover disclosure requirements at the end of our session, and let's talk briefly about this topic. The European regulators have been putting out a lot of guidance recently, and it can be hard for all of us to keep up. But one area that caught my attention was the guidance on disclosure rules regarding inside information. Clemens, could you briefly talk about the key takeaways from the ESMA's guidance?
Yes, Carsten, very happy to do so. Actually, on March 11, ESMA emphasized in a press release the importance of the ad hoc disclosure rules in light of the current crisis. While everybody knows about COVID-19 and its negative implications for the economy as a whole, the impact on different issuers varies substantially. Among our clients, we actually had ad hoc releases because Q1 results were expected to go through the roof, and ad hoc releases because earnings were disappointing. It's precisely against this backdrop that ESMA emphasized that the specific impact of the crisis on issuers may well be price sensitive and inside information, and reminded issuers to disclose any significant impact of the COVID-19 outbreak on their fundamentals, prospects, or financial situation in line with the transparency obligations under the market abuse regulation.
Thank you, Clemens. Olivier, could you please briefly provide us with an update on AMF's recent guidance in this area?
Yes, thank you, Carsten. And in line with the ESMA guidance, the AMF basically confirmed its inside information requirement, which is that issuers should periodically reassess the known or anticipated impact of the COVID-19 crisis on their activity, performance, or prospects, and also determine the materiality and the amount of such impact. If they had guidance that did not take into account an assumption regarding the COVID-19, then they should reassess and restate those guidance and issue a press release in this respect, whether it's confirmed, whether it's suspended, or whether it's withdrawn. And since the month of, in March, I would say that the press releases could vary, and there were some in-between. Since April, the AMF has been very strict and in those press releases. The issuers have the statements.
Thank you very much, Olivier. Can you, Vanessa, give us a little flavor on the UK side, please?
Yes, thanks, Carsten. I think we've all been spending a lot of time with our clients considering the disclosure implications of the COVID-19 crisis. And in the UK, I think the FCA has many times reminded issuers of their disclosure obligations. It also, at the end of March, published a statement saying it appreciated that in the short term, there may be slight delays in making required disclosures as new processes are put in place to assess the situation. And while there's no guidance on what an acceptable length of delay is, past cases suggest that by short, the FCA really means very short. And I think, I think companies are now adjusting to the COVID world, and we're now seeing companies, as they have visibility on the impact of COVID-19 on their businesses, they are making ad hoc announcements, and in some cases even thinking about putting out trading statements ahead of results announcements, etc. So that's really sort of what we're seeing here.
In France, it's the AMF has followed the same approach as the FCA. Basically, it has granted a 2-month extension for the full-year financial report and a 1-month extension for the half-year financial reports for those who close their financial year between December 31st and March 31st. Basically, the AMF has reminded issuers that they should take into account in their annual financial report, of course, the impact of the COVID-19 crisis. It can be also viewed for those that had already closed their accounts as a post-closing event that should be included in their financial statements. And for those that already had finalized their annual report, the AMF reminds that it should be included in the next interim financial reporting. On the quarterly reportings and on the quarterly information, the AMF has asked issuers to issue those only if they are reliable, and if not, then to avoid or at least be particularly careful and announce to the market what are the future financial calendar, and reach out, of course, to the AMF.
Evan, thank you very much, Olivier. Evan, do you have any advice for how companies should be approaching any forward-looking guidance and best protecting themselves from legal exposure down the line?
Sure, Karsten. Well, as I mentioned before, the SEC and other regulators have been very active in issuing disclosure guidance on COVID-19, and particularly for European issuers that are considering accessing the U.S. markets on an SEC registry basis or on a Rule 144 basis. Those disclosures are always going to be measured against U.S. disclosure standards. So I think the SEC guidance is probably still relevant to a lot of companies in Europe. The SEC put out quite a detailed release on various aspects of COVID-19 disclosure, but I actually think the statement that Chairman Jay Clayton and Director of the Division of Corporation Finance, Bill Hinman, put out earlier this month was the more interesting statement. Many times SEC statements can be quite technical, but you could tell that the statement released by the chairman
looks as if we lost.
I think we may have lost Evan there.
John.
I can maybe
John,
come briefly to this topic. So I think the SEC, as Evan was mentioning, is very focused on the benefits of forward-looking information, and they have stressed that they are not going to second-guess companies that include forward-looking information as long as it has appropriate caveating language. For obvious reasons, they were not seeing a trend towards quantitative forward-looking guidance. To the contrary, the first phase of COVID-19 disclosures was really about companies withdrawing prior quantitative guidance. In this new phase of disclosure, especially as the 10Qs are coming out, as I mentioned in the US, companies are describing known trends and known uncertainties to protect themselves down the line. I think the SEC has made clear that good faith attempts to provide forward-looking information won't be second-guessed by them, as long as it has appropriate caveating language. And I think that there is real value, as I mentioned before, in looking at the risk factors that US issuers are including in their 10Qs. The vast majority of companies have dedicated COVID risk factors in those Q1 reports. And although it wouldn't be customary at this time of year for a European company to include it, it's certainly worth looking at to see how the US markets and investors are thinking about COVID risk.
Perfect. Thank you very much, John. I agree. In addition, it will also be key for management at IR to coordinate closely internally to avoid potential footfalls, and we'll continue to have very regular calls with general counsels on all sorts of disclosure questions. Well, I want to thank you all who have joined us today. We are at the end of our program. It took us a little longer than an hour, but I hope you enjoyed it. What this discussion and your questions demonstrate is that all practitioners on the legal side need to consider the impact of COVID-19 and economic repercussions on existing and future capital markets opportunities and needs. If nothing else, this pandemic has highlighted the need to be flexible and to think ahead in order to address the collateral consequences of the pandemic. If you have any questions following this webinar, please do not hesitate to reach out to any of the members of this panel or your usual S&C contacts. We hope that you all stay healthy and safe.